Ladies and gentlemen, Asian guy here. We have spent a lot of time talking about the smart money. We have talked about the central banks. We have talked about the hedge funds. We have talked about the retail stackers, the apes, who are draining the vaults ounce by ounce. But we have not yet talked about the monster. We have not talked about the Godzilla of the financial world, the entity that, when it moves, creates tsunamis that swallow entire economies. We are talking about the institutional money, the pension funds, the endowments, the sovereign wealth funds, the insurance companies. This is the dumb money, not because they are stupid, but because they are slow. They are the supertankers of global capital. They take forever to turn, but once they turn, they cannot be stopped. And right now, the supertanker is turning. Let's put this into perspective. The entire silver market, every ounce of investment-grade silver sitting in vaults, ETFs, and COMEX warehouses, is worth roughly $100 billion, maybe $150 billion if we are generous. It is a rounding error. It is a speck of dust. Now, look at the global pension assets. The OECD estimates that global pension funds hold over $56 trillion in assets. If you add insurance companies and sovereign wealth funds, the number is over $100 trillion. Do you understand the disparity? $100 billion versus $100 trillion. The silver market is 0.1% the size of the institutional capital pool. For the last 40 years, these institutions have operated on a simple model, the 60-40 portfolio. 60% stocks, 40% bonds. They believe that stocks give growth and bonds give safety. They believe that when stocks go down, bonds go up, smoothing out the ride. And for 40 years, they were right. Interest rates fell from 1981 to 2021, creating the greatest bond bull market in history. Because the 60-40 model worked so well, they ignored commodities. They ignored gold. They laughed at silver. To a pension fund manager in New York or London, gold is a pet rock. It has no yield. It has no cash flow. It doesn't fit into their spreadsheets. So their allocation to precious metals is effectively zero, less than 0.5% on average. But the world changed this morning. The repo spike we discussed, the $17 billion liquidity injection, was the death knell of the 60-40 portfolio. It proved that bonds are no longer a safe haven. It proved that bonds are the epicenter of the crisis. When the bond market crashes, the 40% of the pension portfolio that is supposed to be safe becomes a bleeding wound. In 2022, stocks went down and bonds went down. The correlation went to 1. The pension funds lost trillions. They panicked. They realized their model was broken. Now they are staring at a terrifying reality. They have promised payouts to retirees. They need a 7% or 8% annual return to stay solvent. But with inflation at 5% or 10%, real inflation, bonds are yielding negative real returns. Stocks are overvalued. Where do they go? They have to go to real assets. They have to go to commodities. This is the great rotation. It is the movement of capital from the paper economy, stocks, bonds, to the hard asset economy, gold, silver, commodities. And because the paper economy is huge and the hard asset economy is tiny, this rotation will be violent, it will be chaotic, and it will send prices to levels that seem mathematically impossible today. Imagine a swimming pool, the pension money, trying to drain into a thimble, the silver market. What happens? The water overflows, it explodes out. The price of the thimble goes to infinity. We are seeing the early signs. The CalPERS, California Public Employees Retirement System, one of the biggest in the US, recently announced they are increasing leverage to hit their return targets. They are desperate. Desperation leads to changes in strategy. The consultants, the gatekeepers who tell these funds what to do, are starting to whisper the word diversification. For 40 years, diversification meant buy different kinds of stocks. Now it means buy things that the Fed cannot print. If these funds decide to allocate just 1%, 1% of their assets to gold and silver, it would unleash a wall of money amounting to $1 trillion. Remember, the entire silver market is $100 billion. Start. A $1 trillion inflow is 10x the size of the entire market. Even if only 10% of that inflow goes to silver, with the rest to gold, that is $100 billion. That buys the entire existing stock of silver twice. This is the math of the squeeze. It isn't about retail stackers buying a few tubes of Eagles, though that helps. It is about the whales deciding they need a little bit of silver to hedge their inflation risk. Just a nibble for a whale is a feast for the market. And the whales are hungry. They are watching the purchasing power of their bond portfolios evaporate. They are seeing the BRICS nations move to gold. They have a fiduciary duty to protect their clients' wealth. For decades, fiduciary duty meant don't buy risky gold. Now, fiduciary duty means you're negligent if you don't own gold. The legal definition of prudence is shifting. And when the lawyers and the consultants tell the investment committees to buy, they will buy. They won't look at the price. They won't care if silver is $30 or $50. They will just hit the buy button to fill the allocation. They are price inelastic buyers. They need the weight. They need the percentage. If silver goes to $100, they just buy more to maintain the weighting. This is the dumb money wave. They are dumb because they are late. They are dumb because they are buying at the top of the breakout. But their money is green, and there's a hell of a lot of it. You, the individual investor, you are the speedboat. You can turn fast. You are already in. You are front-running the supertanker. When the supertanker arrives, it will create a wake that lifts you to the stratosphere. But make no mistake, the supertanker is coming. The bond market collapse guarantees it. They cannot stay in bonds. They cannot stay entirely in stocks. They must rotate. And the only place left to rotate into is the sector they have ignored for 40 years. Why now? Why haven't they rotated before? Because until now, the bond market was the prudent man's investment. It was risk-free return. You gave the government your money, and they gave you interest. It was the bedrock of the financial system. But the repo crisis and the inflation surge have turned risk-free return into return-free risk. Pension funds operate on a very specific mathematical model called asset-liability matching. They have liabilities, the checks they have to write to grandma every month, and assets, the investments. The liabilities are fixed and growing with inflation, cost of living adjustments. If inflation is 8%, the pension fund's liabilities are growing by 8% a year. If they hold bonds paying 4%, they are losing 4% a year in real terms. They are slowly going bankrupt. They are digging a hole. For a while, they hoped inflation was transitory. They listened to Jerome Powell. They stuck to their 60-40 model. But the data from this morning, the 17 billion repo print, confirms that inflation is not transitory. It is structural. The Fed is printing money to save the banks. That means inflation is here to stay. This realization is the trigger. The investment chief at a major pension fund wakes up and realizes, if I stay in bonds, I fail. I cannot pay the retirees. The state will have to bail me out or I will get fired. Fear is a powerful motivator. The fear of insolvency is driving them to look for alternatives. They look at the stock market. It is at a PE of 25 or 30. It is expensive. If they pile more into stocks, they risk a 50% drawdown in a recession. So they look at the alternative assets bucket. Usually this means private equity or real estate, but commercial real estate is crashing, empty offices. Private equity is illiquid. What is left? What is liquid, uncorrelated to stocks and hedges against inflation? Commodities. For the first time in a generation, the safe play is to take risk in commodities. The risky play is to hold government bonds. The world has flipped upside down. This is where the concept of fiduciary duty flips. Fiduciary duty essentially means doing what a prudent expert would do. For 40 years, prudence meant owning bonds. But if bonds are guaranteed to lose purchasing power, owning them is no longer prudent. It is reckless. We are about to see lawsuits, retirees suing pension funds for not hedging against inflation. Why did you hold 40% in Treasuries when you knew the Fed was debasing the currency? Why didn't you own gold? Once the first lawsuit hits or the first legal opinion is written stating that gold is a necessary component of a prudent portfolio, the floodgates open. Every fund manager will be terrified of being the last one to buy gold. They will herd. Institutional investors are sheep. They move in a herd because of career risk. If you lose money buying bonds and everyone else lost money buying bonds, you don't get fired. You just blame the market. But if you lose money buying gold and nobody else bought gold, you get fired. You are the outlier. However, the reverse is also true. If gold is going up and everyone else is buying it and you don't have it, you get fired for underperformance. You get fired for missing the trend. Right now, gold and silver are starting to outperform stocks and bonds. The trend is establishing. The career risk is shifting from don't buy gold to don't miss the gold rally. Once the herd decides to move, they don't care about the fundamentals of silver supply and demand. They don't care about the COMEX delivery rules. They just care about the allocation. Get me 2% exposure to metals by Friday. That order goes to the trading desk. The trader looks at the screen. He sees silver is tight. He sees liquidity is low. But he has an order to buy $500 million worth. He hits the bid, he lifts the offer, he smashes the buy button. Because the bond market is so huge, $100 trillion plus globally, the amount of money leaving bonds is staggering. A 1% rotation out of bonds is $1 trillion. Where does that money go? It can't all go to stocks. It can't all go to cash, inflation. It naturally flows to the anti-bond. Gold is the anti-bond. It is the asset with no counterparty risk. It is the asset that thrives when real rates are negative. Silver is the high beta anti-bond. It moves like gold, but faster. So the bond market collapse is the engine. It is the pressure cooker. The pension funds are trapped inside the cooker with the heat turning up. The only valve, the only escape, is the commodity sector. They are dumping bonds not because they hate America, but because they love survival. They are panic selling the risk-free asset to panic buy the pet rock. And in doing so, they are validating the thesis of every silver stacker who has been shouting into the void for the last 10 years. We are about to witness the vindication of the contrarian. The institutions are finally admitting we were right, but they are admitting it with their checkbooks, which is the only admission that matters. Now, let's talk about the plumbing. Let's talk about the physics of moving this much money into this small of a market. I used the thimble analogy earlier, but let's get more granular. Imagine you have a fire hose, the full force of a fire hydrant, representing pension fund capital. And you're trying to force that water through a drinking straw, representing the physical silver market. What happens? The straw explodes. The water sprays everywhere. The pressure is uncontainable. The global financial markets are tiered by size. Tier 1, bond market, $130 trillion. Tier 2, stock market, $100 trillion. Tier 3, real estate, $300 trillion. Tier 4, gold market, $12 trillion. Tier 5, silver market, $1.5 trillion total, but only $100 billion investable. Silver is a microcap asset class. It is tiny. It is smaller than Microsoft. It is smaller than Apple. It is smaller than crypto. When a pension fund decides to allocate $1 billion to silver, which is a tiny position for a $100 billion fund, they literally cannot do it without moving the market. If they try to buy $1 billion of physical silver, that is roughly 30 million ounces at current prices. That is nearly 50% of the entire registered inventory of the COMEX. One fund, one order. If they try to do it via the ETFs, like SLV, they create a massive creation basket request. The authorized participants, APs, have to go find the metal. But as we discussed in the unobtainium section, the metal isn't there. So the APs have to bid up the price to induce holders to sell. But the holders are diamond-handed stackers who aren't selling, so the price gaps up. The pension fund trader sees the price rising and thinks, oh no, I'm chasing the market. I need to buy faster before it gets more expensive. He buys more aggressively. The price rises more. Other funds see the price rising and the momentum algorithms kick in. Momentum detected in silver, buy. Now you have 10 funds trying to squeeze through the straw. This is how you get a parabolic melt-up. This is how silver goes from $30 to $50 in a week. The institutions are used to buying treasuries. They can buy $10 billion of treasuries, and the price moves 0.01%. They are used to infinite liquidity. They assume liquidity is a right. They are about to learn that in the commodities market, liquidity is a privilege, and it is a privilege that has been revoked. This mismatch between the wall of money and the available inventory is the fundamental driver of the supercycle. It is simple supply and demand, but with a multiplier effect due to the sheer scale of the capital involved. And here's the kicker. They can't just buy paper silver forever. Pension funds have strict risk controls. If the COMEX declares force majeure, as we discussed, or if SLV decouples from the spot price, the pension fund's risk manager will say, this paper derivative is too risky, we need the physical. Or, more likely, they will buy mining stocks. If the silver market is a straw, the silver mining market is a coffee stirrer. It is even smaller. The entire sector is maybe $20 billion. If pension funds try to put 0.1% of their assets into silver miners, the stocks will go up 1,000% instantly. There are simply not enough shares. We saw this happen in uranium. The Sprott Uranium Trust started buying physical. The price moved. Then the hedge funds came in. The stocks went 5x, 10x. And uranium is a niche market. Silver is a monetary metal with mass appeal. The physics guarantee a blowout. You cannot pour the ocean into a cup. The only variable that can change to accommodate the flow is price. If $1 trillion wants to enter a market with 1 billion ounces available, the price must be $1,000 per ounce. That is the only way the math balances. $1,000 Oz x 1 billion ounces, $1 trillion at $30 Oz. The market cap is too small to absorb the money. The money creates the market cap by driving the price up. This is the concept of repricing. We are not talking about a bubble. A bubble is when price exceeds value. Repricing is when the asset adjusts to the new volume of money in the system. The pension funds are bringing the inflation with them. They are printing the new price tag for silver with their buying pressure. And remember, these guys are slow. They don't day trade. When they buy to hold for 10 years. They take the float off the market permanently. They are sticky money. Once a pension fund allocates to silver, silver is gone. It goes into a vault in Switzerland or London and sits there for a decade. It is removed from the circulating supply. So the liquidity dries up even faster. Each new buyer faces a thinner market than the last one. The price moves become more volatile to the upside. The garden hose is about to burst, and if you're standing there with a bucket, your stack, you're going to catch the overflow. Let's go inside the room. Let's imagine the scene inside the investment committee meeting of a major state pension fund. Picture a long mahogany table, suits, gray hair, a projection screen showing charts. For years, this meeting has been boring. Equities up 8%, bonds flat, we met our target, lunchtime. But today, the mood is tense. The actuary is presenting. He says, "Chairman, our liabilities are up 12% due to inflation adjustments. Our bond portfolio is down 15%. We are underfunded by $20 billion. If we don't fix this, we have to cut benefits or ask the state for a bailout." The room goes quiet. The chief investment officer, CIO, speaks up. "We need returns. We need inflation protection. What do we have?" The analyst speaks. "Sir, we have 60% in the S&P 500. It's overvalued. We have 40% in Treasuries. They are crashing." "Do we have any commodities?" The CIO asks. "No, sir. We sold our commodity index in 2015. It was underperforming." "What about gold?" "No, sir. We deemed it too speculative." The CIO looks at the chart of gold and silver. He sees them breaking out. He sees the repo spike news. He sees the BRICS currency news. He realizes he is naked. He is unhedged against the biggest risk in the market, currency debasement. "Get us exposure," he says. "Now." "How much, sir?" "Start with 2%. We need to catch up." 2% of a $100 billion fund is $2 billion. The trader leaves the room to execute the order. This scene is playing out in Chicago, in Tokyo, in London, in Amsterdam. Thousands of committees are coming to the same conclusion at the same time. The groupthink that kept them out of metals for 40 years is now driving them into metals all at once. There is a psychological phenomenon called FOMO, fear of missing out. We usually associate it with retail investors, but institutional FOMO is much more dangerous. Institutional FOMO is driven by career survival. If a fund manager sees his competitor, the fund across the street, buying gold and outperforming, he panics. "They're going to beat my benchmark. I will lose clients. I need to buy gold too." It creates a stampede, and institutions are terrible at timing. They usually buy at the top, but in this case, the top is so far away because the allocation is starting from zero. Even buying at the start of the breakout is early for them. They will hire commodity specialists. They will launch new real asset funds. The entire machinery of Wall Street will pivot to sell products to these pension funds. Goldman Sachs will issue silver-linked notes. JP Morgan will pitch strategic metal funds. This marketing machine accelerates the trend. Wall Street sells what is hot. When pension funds want silver, Wall Street will find a way to sell them silver, or at least silver exposure. But here is the trap for them. Wall Street will try to sell them paper silver, futures, swaps, unallocated accounts. But the pension fund trustees are reading the same news we are. They see the force majeure risk. They see the nickel sneeze. They are starting to demand physical allocation. We want the metal in a segregated vault. We want the bar numbers. We want audits. This demand for physical audits breaks the fractional reserve system. The banks can't sell the same bar to 10 pension funds if the funds demand audits, so the banks have to go into the market and buy real bars. This drains the COMEX registered inventory. The committee room panic transforms into a vault panic. The banks realize they can't fulfill the orders of their biggest clients. They have to bid up the price to induce miners to sell, to induce refiners to work overtime. And the pension funds, being slow, won't stop buying just because the price rises. They are dollar cost averaging billions of dollars. They provide a relentless bid under the market. Every dip is bought by a pension fund trying to reach its 2% target. This removes the downside volatility. It creates a floor. We saw this with Bitcoin when the ETFs launched. The institutional bid creates a steady upward pressure that grinds the shorts into dust. The retail investor sells on the dip because they are scared. The pension fund buys the dip because they need the allocation. Who wins? The entity with the deeper pockets. This rotation is not a trade for them. It is a strategic shift, a regime change. They are admitting that the era of low inflation is over, and they are positioning for the next 20 years of resource scarcity. So we have the players, pension funds, we have the trigger, bond collapse, we have the physics, garden hose, we have the psychology, panic. What is the price target? Let's do the napkin math. Global financial assets, $300 trillion, conservative estimate of stocks plus bonds. Current silver investment holdings, $100 billion. Silver is 0.3% of global financial assets. If the Great Rotation shifts allocations to just equal the 1980 peak, when precious metals were roughly 5% to 8% of assets, let's be conservative and say 5%. 5% of $300 trillion is $15 trillion. That means $15 trillion of demand chasing gold and silver. Let's say gold gets 90% of that, 13.5 trillion. And silver gets 10%, 1.5 trillion. $1.5 trillion of new money entering the silver market. Currently, there are about 3 to 4 billion ounces of investable silver bullion in the world, bars and coins. The rest is in landfills or jewelry. $1.5 trillion divided by 4 billion ounces, $375 per ounce. That is the price just to balance the portfolio allocation if supply stays constant. But supply won't stay constant. Supply is falling, mining cliffs, and existing holders, you and me, won't sell at 375s. We might wait for $500 or $1,000. If the mania hits and the allocation goes to 10%, like in a true hyperinflationary panic, or if the currency collapses so the denominator, the dollar, becomes worthless, we are looking at $1,000 silver. At $1,000 an ounce, silver is still cheap compared to gold. At a 15:1 ratio, gold would be 15,000. This is the power of the Great Rotation. It is not about the metal changing. The metal is the same. It is about the money changing. It is about the tsunami of liquidity looking for a home. The institutions are coming. It is inevitable. They have no choice. The math of the bond market forces them to act. So what do? You front run them. That is the only advantage the little guy has. You're small, you're fast. You don't need a committee meeting to buy a monster box. You don't need a consultant's approval to buy a mining stock. You can buy now at $30 or $40 while the institutions are still arguing in the boardroom. When they finally arrive, with their trillions of dollars, they will be buying from you. They will be the ones bidding up the price of the asset you already own. This is the greatest wealth transfer. Usually, the institutions dump their bags on retail. This time, retail has the bags of silver, and the institutions are desperate to buy them. The roles are reversed. The dumb money, institutions, is chasing the smart money, stackers. But you must be patient. A supertanker takes time to turn. The rotation doesn't happen in a day. It happens over months and years. But once it starts, it sustains itself for a decade. We are in the early innings. The bond market is just starting to crack. The repo spikes are just the first tremors. The pension funds are just starting to sweat. Wait until the headlines read, CalPERS allocates 5% to commodities. Wait until Harvard Endowment buys gold. That is when the vertical move happens. That is when your patience pays off. Do not sell your silver to a panicked pension fund for cheap. Make them pay the unobtainium price. Make them pay the history price. The Great Rotation is real. The capital is moving. The dam is breaking. I am John A.G. The whales are swimming toward the lifeboat. You're already in the boat. Don't fall out. See you at $1,000.